How's that? Huh? You guys like the geeky glasses today? Alright, look, here's the thing. Today's video is not going to make a lot of sense to some of you. It's going to be a little geeky for others, and some of you are going to eat this thing up. I touched on this a little bit in the past. One of the most fun things for me, so you guys think I just make videos and I talk to people on the phone and stuff, but we manage all 6 of our portfolios. So one of the most fun things that I can do is invest and trade, right? And plan for what we're going to do to those portfolios. If you're not one of our customers, my name is Dustin Tibbetts. I'm a financial advisor with jazzWealth. And what we do is we invest for you. You keep your own account, your own Roth IRA, your own whatever it may be, you know, your own IRA or individual account. And basically we manage those investments for you. Now we use our own portfolios, and like I said, one of the most fun things that I get to do is plan those portfolios, adjust them, make the trades, the allocations inside of them. I wake up every morning as if it's friggin' Christmas. I love it. And I want to bring you into a little bit of what that is. So this will be a little bit of a longer video, and it's going to be extremely geeky. So if you're not into it, I totally understand. But just keep us in mind at jazzWealth, where we'll do all the heavy lifting for you. Now, every Saturday, I put out a video to our customers. We used to do it on Fridays, but we wanted that Friday's data to go in there as well. So we're going to start doing that on Saturday. But I explained to you how our portfolios have done, any changes we've made, adjustments, tweaks, fine-tuning, if you will, to reach our goal. And what I do is I spend my free time trying to take the risk out of the portfolio, but not change the ultimate goal for reward. And so here we go. I'm just going to get into it. We got the geeky glasses off. I'm going to spend some time here on this thing. Again, if this is for you, great. If not, no problem. So what if I told you that for X amount of risk, I could give you this return, or return of Y? Remember X's and Y's, right? So I actually might break this down a little differently, but if you take risk of X, I can get you return of Y. What does that mean? How much risk are you taking? We don't know. It's X, right? We have to solve for that or find some other variables. Well, what's the return? We don't know. We have nothing to compare it to, so we can't really come to any real conclusion. What we can do is say, what if I can get you a return of Y? I said that wrong. I should say, for a risk of 2X, I can give you a return of Y. Now what? Now you go, well, wait a minute, you just promised me that if I take risk of X, I would get Y, right? Well, now we have something to measure here. We've got something. It's not great, right? It's a really, really rough starting point, but we know now that in this case, you're taking twice as much risk for what is perceived to be the same return. And so what I try to do with our portfolios is take as little risk as possible for the return that we're shooting for, all right? So if in this case, X is equal to, let's say, 10, and Y is equal to 4%, we are taking a risk of 10 in exchange for a risk of 4%. So down here, we'd be taking a risk of 20 in exchange for the same 4%. Now, what that 10 or 20 is, that's getting a little bit deep. We'll get into that maybe in a minute. But that's what we're sort of talking about. Now, since you're able to compare X and Y, and you can see that what we have here is, of course, a risk of X to make a return of Y and then double that. Now, what if I told you for a risk of 4X, I can give you a return of 2Y? Would you do that? Would you take that much risk for only twice as much effort? Over here, you said, well, I only have to take this risk and I was going to get Y. So now you want me to quadruple that in order to only double my risk. That might be for some of you, right? But ideally, we want to reduce it to a point where we're back to X and Y. We want to, this is sort of like silly that I'm going over this, but we want to reduce the risk as much as we can for the potential return that we're seeking. And a great example would actually be a lottery ticket. You know where you pick the 3 numbers, and if you guess like 2 of the 3 numbers, you get $1. If you guess all 3 of them, you get like 20 bucks or something, right? For the most part, when you put $1 into that game, every other time you're going to get $1 back. Right? So you've got a certain loss rate that to be expected. Now the game where you have to pick 4 numbers, every time you put $1 in there, you are not going to get that $1 back, but once every 6 times, okay? So there is a equal number, right? You're paying the same amount to play the game, but over here, you're going to win every other time, and over here, you're only going to win 1 out of every 6 times. Which one would you do? So the question is, when you play the game number 1, you guess 3 numbers. Whatever the thing is that you win your money back, great. Every other time you can expect that. Over here, you're only going to win every 6 times, but when you do, you're going to win $4. Which one is the better bet? If you had to put $1 towards one or the other, which one's the better one? You could use the example in a casino or whatever. Well, lucky for you guys, we're really geeky about this stuff, and I don't really like share a lot of it because people won't watch that. But if you ask, or if you're a customer and you're just curious how it works, of course, I would love to help you. But let's talk about how we use this in the markets, and in particular, what is the data? What can you go research to see how this goes if you want to verify what I'm saying? So, in the markets, we use, or here at jazzWealth, we use something called modern portfolio theory. And I had one of the most awesome college professors that taught me this. So what I'm going to try to do is go back to what they taught, but in a little more lighter way, so you don't shut down the app or turn me off. Okay, in modern portfolio theory, there is something known as the efficient frontier. Oh my God, it's a fancy word. Every time the guy would say efficient frontier in college, I used to think of that little blurb that they play in a Western, ta-da, efficient frontier, ta-da. That's why I always thought of that. But there's called the efficient frontier. And basically what we're talking about here is for a set amount of risk, we'll go here with risk, you can expect the return. I meant to say return risk. There we go. So for a certain amount of risk, you expect a certain amount of return. Now, do you think that the more risk you take, the more or the greater your return is? You think that's how it works? It's not how it works, right? So in the markets, as with pretty much anything, the lottery tickets, the more risk you take, the greater your return is not linear. That model does not consistently go higher. If it did, then you'd find big companies on the planet just taking as much risk as humanly possible to get the greatest return. So how this works is actually more of a curve. And at some point, you take so much risk that the return is not that much greater. It starts to level off. And so what happens in modern portfolio theory, we can take a basket of stocks. We can take one of the 6 portfolios that we have published on our website, and we can measure it to see, are we taking the optimum level of risk for the optimum return or the expected return given the risk. You still with me? Hang in there, it gets better. So what we have here now is some things that will pay very little in terms of reward, but you're taking next to no risk, if no risk at all. In fact, some argue that this actually extends down just like that. Not quite to 0, right? But that this extends all the way back into here. What on this planet can you take no risk for and still generate some kind of tiny little return? Any guesses? Real obvious one is a money market account, right? So in a money market account, there's really no risk. I'm going to use blue. So this could be a money market account. It could also be a treasury note, right? It could be like a 2-year treasury note. You're taking no risk. According to the government, it's 100% guaranteed, but they're going to pay you a little bit of money. Actually, they're going to pay about 2.5% for a 2-year treasury note right now. So no risk for a very tiny reward. Now, that's great, but some of you want to take a lot of risk right now, and you say, Dustin, I want to grow, right? I'm young. I want to put my money to risk. I expect a certain level of risk, but I expect as efficient as a return as possible. And so when people go, I'm not going to use jazzWealth, I got this, I can do this on my own, you can. You 100% can. I wouldn't talk you out of that. But I guarantee you, you are taking more risk than you need to take for the same level of returns you might be able to find somewhere else. Well, let's keep walking up this ladder here. Now let's take a little bit more risk. What can you take a little bit more risk for and in exchange get a little bit of a greater return? It could be a corporate bond. So maybe in here you found some sort of corporate bond. I'll just put corporate bond. There's risk there, right? The return is going to be a little bit better because there is risk, but a corporation could go bankrupt, right? Tesla, they issued bonds a while back. There's a little risk there. I mean, maybe you get paid back. You probably will, but there's a chance that you don't. And so what happens, without going on and on about this, as you work your way up, you've got large cap, blue chip stocks, right? Now here's the thing. Right? You go, wait a minute, right? Large cap, I thought I was making some money. Old Dave Ramsey told me to include some of that. What's the deal? I got my large cap here. I got my international growth up here. Wait a minute. I want growth. How is it he's getting all that growth that he says he's getting, right? You can challenge that. So you got large cap. You've got mid cap stocks. And then, of course, all the way over here would be individual stocks or small cap stocks. And in the investment space, small cap stocks are the highest risk with the highest possible return. But that's just talking about those products. I'm talking about a portfolio now. How does a portfolio fit on this? And I'll give you a great example. When you buy a mutual fund, let's say you bought a growth mutual fund, it would fit right about here. Right? If you bought a more of an international or a small cap growth mutual fund, it would fit right here. What's the problem with where that mutual fund is at? Oh, I'm sorry. Right? The problem is you are now taking more risk than you should for the return that you're trying to take. There must be other products or other ways that you can produce a portfolio to get the same level of return, but now for less risk. We're going backwards. We're taking less risk now for the same returns. That's our goal. That's what I just totally geek out on here at Jazz. I take our portfolios and I say, okay, we've got a conservative portfolio and it's currently floating maybe right here. And it's my job to say, take our low volatility ETF portfolio that's on our website. It's my job to constantly try and move it this way. Everything I want to go this way, because currently our portfolios, as you go along the mix there, you got our medium-term aggressive, our medium-term conservative, and as you get into our moderate portfolios, I should be doing these a different color. As you get into our moderate portfolios, all the way into the dividends, and then, of course, the aggressive stock. We're really proud of our aggressive stock portfolio. It's not perfectly efficient, okay? And so when you put a portfolio together, it's very difficult to get to the efficient frontier. Now, like I said, my job is to tweak and constantly adjust every week to bring it close to the efficient frontier, as close as possible. And we measure that, we track that every week. When you hear me talk about the volatility and the returns, any changes we make when I send that video, that's the little adjustments that we're doing. It's not always that we're buying and selling securities. And I know some of our clients are like, when are you going to switch something out? It's not necessarily a matter of switching out a stock so much as which stock or which ETF in those portfolios is the risk getting a little out of whack? Which one can we just tweak a little bit to bring back the risk? Where I'm really proud about this is when the markets fell. If you were to look at our performance going back in February when the markets really sort of took a hit there, our customers did not get hit as hard. Why? Because we were here when everyone else's portfolios were here, right? So you're taking excess risk for not as much return. What do you think happens when the market falls? Now you're taking that risk, you're getting hit that hard, but you didn't get the returns you were supposed to get. Okay, did I geek you guys out too much? The point is, you should learn if you're doing this on your own. I know I'm sort of vague here. I'm not really allowed to give advice on like how to go about doing this or what particular stocks. I get in a lot of trouble for that. If you ever see me put up a video and then take it down, it's because I got in trouble. So I had to put it down. But anyways, what you should do is if you have a basket of 10 stocks, let's say you're investing at some brokerage firm somewhere, you should be able to weigh that basket of stocks against the most efficient way to generate the same return. So it's really geeky. I know it's a really in-depth topic today, but it's really important to cover these things sometimes. Like yesterday, we did some really basic videos, just covering some things that sort of help and motivate, give you something to focus on. I really felt like going like all out here on this one. So this is the efficient frontier inside of the modern portfolio theory. And that's what we use here at Jazz on all 6 of our portfolios. If you are thinking about switching to jazzWealth and you are just curious about those portfolios, the performance, how they do, go to the website. Check out on the portfolios tab. One of these weeks, what I might do is actually send out the update or post it on YouTube or Facebook or something, so that those of you that are not customers, you could see how do I address our portfolios to our customers. I think that's actually pretty smart. I don't think they would mind if we did that. So maybe we'll do that. But in the meantime, check us out at jazzWealth. We've got the portfolios up there. We have the events that we do for our customers. You can also schedule a call to speak directly with me if you want to challenge some of this, or if you have something in particular you'd like to talk about, or you just have questions. Maybe this spurred a question, or you've been thinking, hey, I'm going to work with Jazz, and this was finally the thing that made you think about it. If you would, give us a call. Let us know. We're happy to set up a time to talk with you. And if you would, hit the subscribe button. If I just taught you something, if I just like totally blew your mind, you had no idea anything about that, hit the subscribe button. Let me know what it is that we can cover to make sure that you have everything you need. I'm open for video suggestions as long as I don't get in any trouble and it's totally okay for me to talk about. Happy to do it. Thank you so much for watching, and we'll talk to you soon.